The going concern principle is one of our accounting principles, and it's quite simple to define, yet very difficult to sometimes relate to a question. And it's easy to define because it simply says the business is assumed to go on and exist forever. In other words, the business will always exist as a going concern for an indefinite or infinite time period. So what we assume is if today is day zero, we will assume, even if it's not true, that the business will exist forever. Now clearly businesses don't, they go broke, they get sold and so on, but we're never going to take that into account. Why are we going to do this? Well, the main reason is it's always going to allow us to split assets into current, so the assets that will be converted into cash or consumed within 12 months, and non-current, the ones that won't until after 12 months. And that's, for a lot of businesses, might not be true. Maybe we are planning on selling our business in 3 months. Well, then we should list every single asset as current. But that's not how it's done in the real world. We will assume the business will exist forever. Even when we sell it, someone else will buy it, so therefore that car still becomes a non-current asset. So let's say the owner did intend to sell the business in 6 months' time, so they've got a plan. You can do that obviously and have a plan, but in your accounting records, that assumption will never appear. It totally breaches the going concern. Even if the owner intends to sell the business, it's still assumed the firm will go on forever, and that way items like the premises, the vehicle and the machinery are classified as non-current assets. So looking at that example, we can see, well, one thing the owner did, they said they're getting rid of the business in 6 months, so they've listed every single asset as current, including premises, office equipment and vehicles. Well, that's actually wrong. Even though the owner probably is going to not have the business in 6 months, we would still keep these bigger sort of longer term assets. We'd always call them non-current. Looking at some examples of questions you might get asked, this is where it gets a little tricky. So let's look at our first example. Explain why asset accounts are not closed at the end of the period. So that's a tough question to answer. So let's have a go at it from the going concern standpoint. So for theory questions, we're going to identify it, define it. The business is assumed to continue as a going concern for an infinite period. And now we'll relate it. How are we going to say that? Well, what we're going to say is at the end of each period, our assets are actually balanced. They're not closed. Only revenues and expenses are closed. But why? The reason they're not is because we expect them to generate future economic benefits in future periods. That might not actually be true. We mightn't have a car for longer than 12 months. We might be intending to sell it within 3 months. It doesn't matter. We still balance that asset account into the next period. And most importantly, for long-term assets, we never write them off as an expense in the current period. We always depreciate them over a number of periods. For instance, if we bought a car and we estimate it's going to last 5 years, how do we know our business will be there in 5 years? A lot of businesses don't last that long. Well, we don't worry about that. We use the going concern principle and just assume that even though we might be broke in 6 months, we're still going to put that car in as a non-current asset. Let's look at a second example. Explain why it's necessary to record balance day adjustments relating to the firm's non-current assets. Identify going concern, define it. Now when I relate it, I'm going to say some non-current assets will be owned beyond the next reporting period. I mean, I don't know that for sure. I'm just going to make that assumption under the going concern principle. And that must mean I've got to make a balance day adjustment at the end of each period. In this case, we call it depreciation, and that'll recognize the economic benefits consumed this period. So I might actually have the car, but it doesn't matter. I'll assume I will in future years, and therefore I just take out a little bit this year called depreciation as my expense.